All right, perfect. Thank you very much for joining us on another edition of the Into the Block webinars, where we try to cover the hottest topics related to crypto, the intersection of crypto and data science. Today, we're gonna do we're gonna provide a quick overview of some DeFi analytics that every investor should pay attention to. We have been doing several sessions about DeFi quant strategies, DeFi in-depth analytics, and we wanted to take a step back and just show you some very simple perspective about this new market that we think are relevant to every investor or trader in the space. The agenda is fundamentally simple. We're going to talk about the challenges and opportunities of analytics in the DeFi space, and we're going to show you a ton of data. And then at the very end, I would like to take a couple of minutes to just talk about provide a perspective of how we see intelligence in the decentralized finance space evolving over time. Before that, a couple of logistics points. If you want to use any, if you have any questions, please use a Q&A panel. Part of the team is monitoring those, and I will stop several times during the presentation to take questions. Before we start, as we usually do, I want to give you a quick update of the last 3 weeks of Into the Block. That's in every webinar we try to show you the progress in the from the time of the last webinar. So some of the most notable things that happened in the last 3 weeks, as we mentioned last time, we crossed 100 clients last quarter, including some notable additions. In the last 3 weeks, some of those clients have gone live. Last week, Luno, the exchange that was acquired by the currency group, went live with a series of analytics powered by Into the Block. Similar Bitcup, that is the biggest the biggest crypto exchange in Thailand, went live as well. Somebody in the chat posted that my name is that I have the wrong name, and that's true. I was using the name of our head of marketing. It was a mistake. Sorry. So some of the other clients have gone live, like such as and sorry, something happened. Okay. Here we go. Just 1 second to do this again. Technical problems. Okay, so some of our clients like Coinpedia went live as well, and again we have more and more launches scheduled for the next few days. Some other interesting things: the release of DeFi analytics, that is really the center of today's presentations, has been received extremely well. The feedback has been incredibly positive, and in the next few days, we're releasing some features that have been actively requested by our customer base, such as social sharing, the opportunity of sharing some of these analytics in social media, data downloads directly, and we're adding new DeFi analytics for several new protocols, such as Balancer and Aave. So I encourage you to sign up, and there is a handful of UI improvements that we're also sharing. So with that, I would like to start with the session today with a very, very bold statement. So we believe that decentralized finance have the opportunity of becoming one of the most intelligent vehicles in the history of capital markets. What does intelligence really mean in this context? Well, I mean, if you think about DeFi protocols, they execute completely on chain, so they leave a lot of data footprints about their behavior, the behavior of traders, of investors, and that footprint could be used in the creation of new DeFi protocols. So you have this cycle that is constantly feeding off each other and the different elements and conspiring to the creation of more and more intelligent DeFi protocols and products, when we think about the different dimensions of DeFi intelligence, a very simple taxonomy that we believe has worked for us, and we think is very, very easy to understand, is if on one axis you put the complexity and another is the value that you obtain from that intelligence, you can think about intelligence and analytics that are centered on a single protocol like Uniswap or Balancer, those type of analytics. You can think about intelligence that expands across multiple DeFi protocols, such as trying to trace trades between Balancer and Uniswap and things like that. And then you can think about intelligence across into the DeFi and CeFi world. So imagine an intelligence that relates futures and perpetual swaps on derivative exchanges with some behavior on DeFi protocols. And obviously, as you go up that ladder, the value is increasing and so is the complexity. So this is a framework that we think is very important, and it works when it comes to trying to understand DeFi intelligence. But it's not all rosy, right? There is a ton of challenges when it comes to understand and try to extract value from DeFi protocols. One of them is obviously the complexity of these things. I mean, the DeFi space is far from simple. And from each one of these protocols, whether you're doing lending or borrowing or staking or AMMs, is extremely complex, right? There is a lot of moving parts in each one of those protocols. So trying to extract meaningful intelligence is very, very difficult. Then we have this factor that we call the data versus protocol behavior mismatch. That is, sure, we have all the data for a specific protocol, but sometimes what is recorded at the blockchain level doesn't quite translate into specific insights and analytics that you can extrapolate. And then finally, when you go into multiple protocol interactions, if you see transactions going from one protocol, from Compound to Aave to Curve and things like that, it's just hard to understand what they're trying to do, right? So trying to extrapolate meaningful intelligence, actionable intelligence that is understandable, relatable by retail investors is very, very difficult in this space, even with all the data being there at your disposal. So given those complexities, the industry has gone into tangents that we think are very, very dangerous, right? So some things that we believe are the wrong way to think about the space is to try to use a single indicator, like market cap, like value lock, like whatever, to try to understand the behavior of the entire space. Obviously, total value lock has become sort of the universal indicator when it comes to DeFi. And it works for some protocols and it has some merits in some protocols, and for some others it's completely misleading. And I'm going to show you a few examples of that. So the lesson the takeaway from that point is that no single indicator can explain a complex market like decentralized finance. Value lock specifically could be very, very misleading in many scenarios. I'm going to show you some examples. Different protocols. So the idea of when you're analyzing something like a lending protocol like Compound or Aave or an AMM like Uniswap or Balancer is completely different, and you shouldn't try to see it through the same lens. The market is highly inefficient and unpredictable. Crazy stuff happens every day. So I'm going to show you a couple of crazy examples of the last few days, and you should be prepared for it. And some things are really, really, really hard to understand the recent hack on the harvest hack literally had us on Monday trying to figure out whether a lot of our metrics were actually accurate, because you know, are things that are very hard to plan and predict and prepare for. So what I want to do in the next few minutes is show you a ton of analytics that we think you can find all this in the Into the Block DeFi release, and it's free for now. So I wanted to show you a ton of analytics that are very simple to understand, and that probably illustrate some key points that should be relevant to DeFi traders and investors. So, for instance, one of the indicators that we like a lot to follow is the what we call what is called the wrapped Bitcoin on Ethereum. So the volume, the amount of Bitcoins that are being used in Ethereum, which is a proxy for to use in DeFi protocols such as AMMs and things like that. These days, wrapped Bitcoin is at an all-time high, and that's a sign of momentum of how investors are seeing the market, and a lot of Bitcoin holders trying to participate, right? To use those holdings to participate in the DeFi market. So it's one that you don't find in many mainstream sites, and it's one that we think is very easy to understand and very useful to keep an eye on. So we talked about value lock a lot, and I wanted to show you a couple of examples. So when value lock is typically used as a indicator of activity and value assigned to a specific DeFi protocol, and it doesn't quite correlate many times with on-chain activity. So here's an example of the top assets by value lock, and you can see that Uniswap is leading the chart. But then when you look at the active addresses on those protocols, you can see that Uniswap was actually declining, and DAI is the leading protocol. So it doesn't quite correlate one with the other. If you want an example a little bit more pragmatic, let's look at lending activity. So look at this chart on the value lock for lending protocols, in which Maker was leading. It's the protocol with the highest value locked. But then when you actually look at the loans that are being produced by those protocols, Compound is by far the leading protocol in that category. So in this case, looking at value lock as a proxy to understand lending activity in a lending protocol is a mistake. One metric that we use a lot that we find to be incredibly useful is the cost of gas, right? Obviously, because we build so many quant strategies for this space, gas is very important to us. But as a trader and investor in the DeFi space, you need to keep an eye on the cost of gas. And when you look at this matrix by hour, by day, you find weird things, like gas becomes cheaper in very awkward hours of the day, like during the weekends in the 1 to midnight to 4 a.m. And you can use a lot of those trends to accumulate gas when it's cheap and try to spend it when it's more expensive in a specific trade. So the cost of gas is one of those analytics that we think are very relevant to anybody investing or trading in the DeFi space. Then one of the things that is that I always find remarkable is when you look at the lending space, right? When you look at borrow rates or lending rate, this is the difference, right? The huge difference between different protocols. Look at this matrix in which on the top you have the different tokens, and on the vertical, on the rows you have the different lending protocols, and look at the rates. Look at the borrow rate. So you can for DAI, look at the difference between different protocols. So this type of thing opens the opportunity for all sorts of arbitrage between not that straightforward, but it does exist. And when you look at lending rates, it's the same, right? The same. Look at the protocol, look at the lending rates for some of those assets, and look at the difference. Right. So if you figure out the mechanics, right, you can arbitrage between many of these protocols. Then Moving from lending to the space of automated market makers, which is the hottest space in AMMs. When we look at liquidity pools, the metric that is typically used is liquidity. Liquidity and trading volume is almost used interchangeably, right? We assume that pools that are very liquid tend to attract a lot of trading volume, but that's not quite the case always. So look at this analysis of the top trading pools. You can see that Uniswap dominates by far the space, and by volume, the Ethereum to USDT pool has the highest volume, but then when we look at liquidity, it's third, right? And the wrap Bitcoin to Ethereum has the highest liquidity. So a trap to not fall for, right? It's you need to look at both indicators, not assume that one is a proxy to the other. I mean, it is true that it's hard to find a highly liquid pool with very small volume, but that doesn't mean that they go one-on-one. Then when we look at liquidity pools in some of these AMMs, some of those behaviors, some pools are highly predictable and very consistent. So look at the Uniswap pool between the Uni token for governance in Uniswap and Ethereum, and you can see that there are many more swaps between Uni to obtain ETH that's swapping ETH to obtain Uni. So you can see that the blue line dominates, and sometimes the gap is really high. And that tells you that almost all the time, most people try to get ETH out of that pool that try to get Uni. However, when you look at, that's not the case for many pools. When you look at pools like the wrap Bitcoin and Ethereum, is all over the place, right? Sometimes some people, there are more swaps for wrap Bitcoin, and sometimes there are more swaps, a higher volume of swaps for Ethereum. So hard to predict, and very inconsistent from pool to pool. So keeping an eye on this type of metrics is sort of important. In AMMs, we have this phenomenon of the impermanent loss, right? That occurs when you're acting as a liquidity provider. The token move against you. So we actually built this calculus simulator for impermanent loss to help investors understand what they could be exposed to, and it is a problem, right? So this is a very simple example. In Uniswap, in the Uni to Ethereum pool, in which we're trying to simulate $10,000 as a liquidity provider compared to holding Ethereum, and you can see that the losses are nothing to ignore, right? So many people think that acting as a liquidity provider is a very safe game. Not quite. I mean, there is exposure to impermanent loss, and in those, sometimes that impermanent loss could be very significant. In many of these protocols are quite unstable. We all saw the drama of Sushi Swap and Uniswap, and liquidity in some of these protocols move like crazy and drops super fast. So this is, for all the hype created around Sushi Swap, look what's happened, right? Look at this sharp drop on liquidity. Later, the last few days has been more stable, but still, I mean, who can deal with this drop on the way down in a couple of days? So you need to be prepared as an investor or trader playing in this space. You need to be prepared for this type of drastic changes. Then a lot of tokens a lot of protocols in the DeFi space are introducing tokens as a governance mechanism, and yield farming those tokens has become some of the trends, one of the hot trends in the space. Well, when you actually look at the profitability of many of those positions, it's not very clear that it's a very good investment, right? So this is an analysis that has been into the block since day one, called the in and out of the money, that uses a machine learning technique to try to estimate profitability across different wallets in a space. And when we do that analysis for the comp token, you can see that about 6.5% of comp investors actually made money. 84 are completely out of the money. So as far as investments go for comp, not very clear that it has been highly profitable. How about Uni that just launched a few days ago? So this is a different analysis, a different variation of the in and out of the money that we call in and out of the money around the current price, that tries to give you an idea of profitability among wallets that are in close proximity to the current price, which are the ones that trade, right? Plus minus 15% of the current price. That is an indication of wallets that will be active depending on a price movement. Well, it turns out, look at this green these green bubbles compared to the red bubbles. The green ones are the ones that are profitable. The red ones are the ones that are at a loss. And the size is obviously the volume. So about 99.5 of Uni investors around the current price are out of the money. I mean, that's crazy. So so it's something that you need to factor in when you're trying to farm some of these governance tokens. Then I mentioned at the beginning that there is a lot of weird stuff that happens in DeFi protocols that are hard to explain. So I want to show you one that we have been puzzled by it for the last few days until we finally figure out what it was. And I'm going to walk you through a few steps. So this is an analysis of Compound. If you look at the barrel of AMM volume in Compound, has been very consistent, increasing, but very consistent, right? Not big spikes. But then when you look at the users, we saw this big increase, right, of active addresses, and then this drop, and then this big increase. And you're like, what's going on? Like, I mean, it's people going into Compound. Like, as a trader or investor, like, how do you make sense of any of this? So drilling, you're gonna see behaviors like this all the time that are hard to reconcile. When you start drilling into it a little bit, we were able to trace it to an increase in volume in USDC. Like you can see that the utilization ratio and the lending rates of USDC were increasing like crazy, and we're like, okay, and that correlated with the amounts, and then we're okay, why? Like, what's happening with the USDC? There is nothing happening with the project or whatever that is justifying this. This is an analysis that one of our backend engineers, visualization, created to trace all the, it's something that we use internally, it's not part of the product. And we were able to identify there were tens of thousands of transactions for the amount of $3, only $3, that were happening in USDC all the time. And they all came from the same wallet. I'm gonna save the name of the entity, but because we thought it was a market manipulation initially, but it wasn't. So a lot of $3 transactions just happening from the same wallet, and we finally discovered that Coinbase was doing a tutorial on DeFi and was giving users $3 to be able to test some things, and everything was using the USDC, and that was causing a massive spike on Compound. And if you go today, you see it, right? Like it's a ton of transactions for $3. But as a trader, you see that spike and you think that there is something meaningful happening with the protocol, and it isn't. It's just people playing to learn DeFi protocol. So this is the type of thing that is important to analyze and to get some meaningful intelligence around it. So in the last few minutes, I want to leave you with a couple of ideas about how we see the future of intelligence in DeFi protocols. And very, 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 very simple. We think there is going to be a transition from DeFi protocols to be a producer of data and a source of data for intelligent models to be a consumer of intelligence. And we think as we go, so if you want to do the traditional crossing the chasm models, we think that the initial wave of DeFi protocols are focusing on automation and programmability. The basic primitive, lending, borrowing, staking, AMMs. Once we get, and those protocols produce data, and that data is used by people like us to try to extrapolate intelligence. And that's the dynamic of the market today. The future is that we're going to get intelligent protocols. We're going to get DeFi protocols. We're going to have DeFi protocols that incorporate that intelligence as a first-class citizen in their code. And let me give you a few examples. So imagine the next Uniswap. that instead of doing a 50-50 ratio and a very basic arithmetic in terms of calculating the weight of each token in a pool, uses a machine learning model that takes a bunch of market signals and tell you exactly what the right distribution is. Maybe Uniswap is a bad example for this, but Balancer certainly is a good one, right? If you have many protocols, and how do you assign the weights from moving from a static statistical function to a more dynamic thing that is using market signals? Imagine the next generation of wide-earn protocols of the mini robo-advisor things that instead of just using data at the blockchain level, start using predictive models to try to estimate which token is going to increase in value or not, and try to allocate the positions that way. Then at the same token, at the same time, we're going to have protocols that incorporate alpha natively. Like today, we build trading strategies on top of those things to generate alpha. Well, imagine that those strategies become tradable. We have become tokens in and of itself. We have tokens for passive strategies, right? We have Y-Earn and all these row advisors for passive strategies. So why not for active strategies that incorporate intelligence and machine learning and predictive signals for that? And then obviously the next generation of row advisors, right, that become more intelligent and it's not only trying to do combinations of arbitrage mechanics, but try to incorporate intelligence signals about the market. So those are some of the points that I would like to leave you with. We think the market is going to transition from automation to intelligence in the next few years. We think some trends in DeFi are here to stay. We don't think lending is going to go away. We don't think AMMs are going to go away. Other trends, well, we'll see what happens. With that, just to do a quick recap and open for Q&A. Remember, if you have any questions, just use the Q&A panel. So the DeFi market is a goldmine of data intelligence. Use value lock wisely. No single indicator can describe a complex market like DeFi. You need to go into the specifics of each protocol to try to extrapolate meaningful intelligence. And the future is one in which DeFi protocols actually incorporate Intel as a first-class component. Take a look at the DeFi analytics release that we did about a month ago, and please give us a ton of feedback. In the next webinar, in 3 weeks, we're gonna take I recently published a piece in CoinDesk about why most crypto quant strategies fail. We're gonna dive into that thesis. We're gonna look at predictive models, machine learning models applied to crypto and quant strategies, and show you why. What are the causes that make most of those models fail? And take a look at new machine learning techniques that are looking very promising in this space. Definitely a level deeper than what we cover today. So the link for the next webinar is in the chat. And if you have any questions, let's use the Q&A. So Kevin is asking if ITV has any intention of creating products of alpha quant strategies as a company. ITV does build quant strategies for our quant hedge fund clients, with our quant hedge fund clients. We don't talk about plans about shipping some of those as tokens at the moment. Is not in our roadmap. The people are asking if the webinar is recorded. Yes, it's recorded, including the gap that we have at the very beginning, and it will be posted in our YouTube channel in the next few hours. Any other questions? Andrew is asking, what changes do you expect to take place on DeFi when L2 launches? I mean, a lot. Obviously, everybody, I mean, staking is an important piece of this puzzle, right? And when you look at the proof of stake protocols, obviously Ethereum or BNX is gonna be the big release. So many things are going to change. The cost of gas is going to change. obviously, and a lot of these protocols are going to change its underlying dynamics. And I think L2 layer 2 protocols are going to power sort of a new generation of DeFi, so new forms of derivatives and things like that we're not seeing today. Mark is asking, have you heard about liquid finance, and if so, what's your opinion? Not familiar. Actually, I have read about it. We haven't deep dive into the protocol yet, so I'll prefer to pass on that. Any other questions? Questions going once, questions going twice. Okay, well, thank you very much for joining. Sign up for the next webinar. It's going to be awesome, covering topics around quant and predictive models for crypto, and give it a try to our DeFi release and send us your feedback. And I hope to see you in the next webinar. Thank you very much.